Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Deluxe Corporation Annual Report. Deluxe Corporation offers a wide range of services and products to small and medium-sized businesses, as well as financial institutions in the United States and Canada. The company's four main segments include merchant services, B2B billion payments, data solutions, and print. Under these segments, Deluxe provides various solutions such as credit and debit card authorization and payment systems, processing services for retail and service businesses, treasury management solutions, and fraud and security services. Additionally, the company offers data, analytics, and marketing services for business-to-business and business-to-consumer marketing. Deluxe also provides financial institution profitability reporting and business incorporation services, printed personal and business checks, and business essentials such as printed business forms and accessories. Furthermore, the company offers branded promotional solutions, including print, apparel, and digital storefronts. Overall, Deluxe Corporation's diverse range of products and services cater to various needs of its clients, making it a one-stop shop for businesses and financial institutions in North America. The significant increase in Deluxe Corp's stock price over the past year can be attributed to several key news events. One of the primary drivers was the company's strong fourth quarter and full year 2025 earnings, which exceeded market expectations. The announcement of these financial results on January 28, 2026, was well received by investors, contributing to a surge in stock price. Deluxe Corp's strategic shift towards payments and data has also played a crucial role in its success. In 2025, revenue from the payments and data segments grew to 47% of total revenue, up from 43% in the previous year. The company anticipates that these segments will achieve parity with its print segment later in 2026. In addition to these developments, Deluxe Corp's credit standing improved in 2025, marked by 2 upgrades from S&P and a positive outlook from Fitch. This improvement in credit standing has likely boosted investor confidence, contributing to the increase in stock price. Furthermore, the company's decision to sell certain assets related to its Safeguard business and its partnership with Payfinia to expand access to Pays, a bank-supported digital wallet, have also contributed to increased investor confidence. The declaration of a quarterly dividend of $0.30 per share has further boosted investor sentiment. Overall, these developments collectively contributed to increased investor confidence and a significant rise in Deluxe Corp's stock price over the past year. Deluxe Corporation market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $4 billion. Deluxe Corporation trades at a higher price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.73 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 78% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 4.58%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline in the payment processing and services industry can be identified through a review of recent financial reports. One key driver of revenue growth is the increasing adoption of digital payment methods, which has led to a significant decline in checks revenue. On the other hand, segments such as merchant services, data solutions, and treasury management solutions have shown substantial revenue growth. Another factor contributing to revenue growth is the shift towards data-driven marketing, with companies investing heavily in targeted and personalized marketing efforts. This trend is evident in the substantial growth of the data-driven marketing segment. Additionally, acquisitions and divestitures have played a significant role in shaping the industry's financial landscape, with some companies experiencing gains on sale of businesses and long-lived assets. However, not all trends are positive. The operating expenses of some companies have increased significantly, which may be due to various factors such as expansion of services, hiring new employees, or investments in technology. Furthermore, the exit from certain business segments has resulted in goodwill impairment charges, highlighting the challenges faced by companies in adapting to changing market conditions. Overall, the industry's financial performance is characterized by a mix of growth drivers and challenges. Companies that are able to adapt to emerging trends and technologies will likely experience revenue growth, while those that fail to do so may face decline. Net income and profit margins changes. An overview: the net income of a company underwent significant fluctuations between 2024 and 2025. Initially, it increased by $29.3 million to reach $82.2 million in 2025. However, this growth was attributed to various factors such as accruals for legal matters, patent infringement claims, asset impairment charges, reduced demand due to economic uncertainty, and increased costs associated with defending intellectual property rights. Despite the initial increase, net income ultimately decreased in 2025 compared to 2024 due to intensifying competitive pressures, decline of check usage and revenue, pricing challenges within the financial institution sales channel, and increased competition from digital payment solutions. This decrease was a result of various negative factors that outweighed the benefits of pricing strategies and cost management actions. In terms of profit margins, the adjusted EBITDA margin experienced an increase from 19.4% to 20.2% in 2025 compared to 2024, representing a 3.8% growth. This improvement was largely attributed to the completion of the North Star program, which led to a year-over-year increase in adjusted EBITDA and adjusted EBITDA margin. However, operating income margin, operating income/total revenue, decreased from 9% to 10.9% in 2025 compared to 2024. This decline was partially offset by the significant decrease in restructuring and integration expense from $50.5 million in 2024 to $20.5 million in 2025, contributing to the improvement in profit margins. Overall, the changes in net income and profit margins were influenced by a combination of factors, including pricing strategies, cost management actions, completion of the North Star program, and restructuring and integration expenses. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has achieved positive operating cash flow, marking a notable shift from previous years. This achievement is particularly evident when examining the net cash provided by operating activities for 2025, which stands at $270.6 million. This substantial amount of cash generated from the company's day-to-day operations demonstrates its ability to sustain itself financially and invest in future growth initiatives. The positive operating cash flow is a testament to the company's efficient management practices and effective operational strategies. It also suggests that the company has been able to manage its expenses, optimize its revenue streams, and maintain a healthy balance between its financial obligations and investments. Overall, the company's ability to generate positive operating cash flow in 2025 is a significant milestone, indicating a strong foundation for future growth and success. The company's financial health has shown a positive trend in recent years. A significant decrease in debt level is observed, with total debt decreasing by -4.6% from $1,503,100,000 to $1,429,400,000 between 2024 and 2025. This reduction in debt level is consistent across multiple summaries, indicating a substantial improvement in the company's financial position. In addition to the decrease in debt level, interest expenses have also seen a slight decline. Interest expense decreased by -1.1% from $123.3 million to $122 million between 2024 and 2025. This reduction in interest expenses is likely due to the decrease in debt level, as the company pays less interest on its outstanding debts. Overall, these changes suggest that the company has made significant progress in managing its debt and reducing its financial burdens. The decrease in both debt level and interest expenses indicates a healthier financial position for the company, which can be beneficial for future growth and development. The company's performance varied across different segments and regions in the given period. On the positive side, print emerged as one of the top-performing segments, contributing 32.4% to the consolidated revenue. Merchant services also performed well, with a significant investment made in this area. B2O billion payments was another segment that showed good results. In addition to these strong performers, North America was also a region where the company excelled. The region's performance was likely driven by the company's established presence and customer base in this market. On the other hand, some segments and regions struggled during this period. The business forms and promotional products market faced significant challenges due to technological advancements, leading to a shrinking market size. The traditional financial institution sales channel also experienced difficulties, with competitive pricing from institutions aiming to preserve profitability amidst falling check volumes. The checks business was another area where the company faced decline, with usage steadily decreasing since the mid-1990s. Data solutions and other payment solutions were also underperforming segments, contributing relatively low revenue to the consolidated total. The management is optimistic about the company's outlook and strategy. They are accelerating their transition towards digital solutions, which will drive operational efficiencies and sustain profitable growth. The company is focused on innovation, expansion into new market segments, and disciplined expense management to achieve this goal. To support these efforts, the company has implemented cost management actions and process automation, invested in innovation and scaling product offerings, and allocated capital expenditures of $90–100 million for 2026. Additionally, they have $287.5 million remaining for share repurchases, which will help maintain a strong balance sheet. The company's North Star program is a comprehensive initiative that balances cost management with targeted investments to support sustainable growth. With sufficient liquidity to meet its operating needs and contractual obligations, the company is well-positioned to execute its strategy and drive earnings and cash flow growth. Overall, the management's focus on digital solutions, innovation, and disciplined expense management positions the company for long-term success. The company has made several strategic moves through acquisitions and divestitures to restructure its operations and focus on core businesses. In terms of acquisitions, the company purchased certain assets from J.P. Morgan Chase Bank's CheckMatch electronic check conveyance service business for $24.6 million in August 2025. Additionally, it acquired other unspecified assets from the same business at an unknown date. On the divestiture side, the company has exited several non-core businesses to streamline its operations and reduce costs. These include the small business distributor channel in the print segment, which was sold for approximately $25 million in February 2026. The company also exited a joint venture related to business payment distribution technology platform, resulting in an asset impairment charge. Furthermore, the company has exited its payroll and human resources services business, which had been a significant contributor to goodwill impairment charges totaling $7.7 million in 2024. This exit is considered substantially completed, marking another step towards restructuring the company's operations. The print segment itself has also been exited due to continuing secular declines. Overall, these acquisitions and divestitures reflect the company's efforts to adapt to changing market conditions and focus on its core strengths. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done consistently. In fact, the financial records show that cash dividends were paid out to shareholders, amounting to $552 million in 2025. This indicates that the company values its shareholders and is committed to sharing a portion of its profits with them. In addition to paying dividends, the company has also been proactive in buying back shares from the market. In October 2018, it received authorization to buy back up to $500 million worth of shares. This move not only boosts shareholder value, but also demonstrates the company's confidence in its future prospects and financial stability. While the company's inventory levels have been steadily increasing over the past 2 years, reaching $3.6 million in 2025 and $3.7 million in 2024, there are no significant concerns about supply chain disruption mentioned. However, potential risks to supply chain disruption do exist, primarily due to external factors such as rising prices, reduced availability of essential materials and services, global instability, changes in trade policies, tariffs, labor shortages, adverse weather events, or financial difficulties among suppliers. The company's proactive approach to managing inventory levels is evident from its regular reviews and provisions for excess and slash or obsolete inventory based on historical usage and future demand forecasts. This suggests that the company is aware of the potential risks associated with inventory buildup and is taking steps to mitigate them. Nevertheless, the possibility of supply chain disruption cannot be ruled out entirely, given the current global economic climate and the various external factors that could impact the company's ability to obtain materials and services at competitive rates. That concludes the financial summary for Deluxe Corporation. Feel free to comment below, and I will be happy to answer them when possible.